Strategy. We're joined now by our panelists, Sean Corrigan, Chief Investment Strategist at Diapason Commodities Management, and Darius Kowalczyk, Chief Investment Strategist at CFC Seymour Limited, Hong Kong. Darius, let me start with you first. Markets in Asia and Europe, of course, bracing for what the Fed will say and do this week. Would another Fed rate cut help the markets out? And what happens if the Fed holds back?
I think that markets are pricing in a small rate reduction, and the Fed will probably not disappoint us. If, of course, they leave rates unchanged, then everything depends on the rationale, because should the Fed conclude that threat to stability of the banking system is gone, then even without a rate cut, the markets would probably cheer such a decision. But if the Fed simply focuses on inflation threats, then a lack of easing would be disappointing, because markets would the hope that the Fed would support growth further would fail. But I think the risk of a surprise is fairly low.
What's interesting, Sean, of course, is that the dollar and actually Treasury markets are sort of priced in an end to Fed easing, maybe one and done is the view. What are the implications of that for sort of broader markets, well, I think if that is the case?
Yeah, I think if you look at it, we have this March 17th St. Patrick's Day low in all the markets. So you have the height of risk aversion at that period, when all the credit spreads were high, the breadth in the stock market was low, the market itself was on its low. Swissy and yen were the two strong currencies, the dollar was the weak currency. And the past 6 weeks have been a story of reversing that. Now, up to that point, this was when Bernanke and Mishkin and the Fed board were in charge, and the New York Fed were in charge of putting all these extraordinary measures in place. Now that things seem to have calmed down, we have this, it may only be a bear market rally, but we've had this period of calm and reversal. I think the governors will have a bit more say, and as we know, the regional presidents, and as we know, they're a lot more anxious on the inflation side than on bailing out Wall Street. So I think that's kind of a rational decision. As you say, in the market price, when that happens, I think the real cue is to see, has the market been double bluffing itself? If we don't get any extra stimulus, if the Fed does give a hint that it's slowing down, will the market suffer a back reaction from here? Although it's being brave going in, it'll be very interesting to see if that's maintained afterwards.
Sean, Brian Shackman here in the U.S. Of course, the Fed's a big story. Oil also just a huge story, closing in on $120 for a barrel of oil. It's kind of mind-boggling. Put a perspective from where you sit in terms of how much of an issue is it? Is it not an issue at all from the issues you deal with on a daily basis?
Well, I think if you look at oil and you plot it against the S&P banks versus the broad S&P, it's been almost an exact mirror image throughout this whole credit crisis period. So you could argue that oil has performed some of the functions of gold in that it's been a flight asset from paper money, and it's been a flight asset from credit stroke financial markets. What we haven't seen, of course, in oil's case is a reversal, since all the other markets have gone into reversal. We have had targets here around about 120 for some time now. I have a slight wager with my boss whether it stops here or whether it goes to 125. But if you look at the fundamentals of the oil market, they are actually quite weak, certainly in the West. Inventories are comfortable. Crack spreads, the demand for the end product of particularly motor gasoline in the West is low. Refineries are running at very low capacity. We don't seem to need a lot of physical oil, so this is, I think, much more a financial market trade, hence more vulnerable.
Darius, I want to put it to you. I mean, if it's been a bit of a safe haven place to put some money and there hasn't been the pullback, as an investor, Darius, how do you play it moving forward?
I think that in the near to medium term, developments in the price of oil will depend heavily on what happens with the value of the US dollar, and to some degree on financing costs. So financing costs should not fall much further, if at all, because the Fed easing is coming to an end, which will remove this part of support for the price of crude. And I believe that the dollar will continue to recover over the course of the year, which will make oil more expensive for non-dollar denominated buyers. And therefore, my view is that while we may have some short-term new records due to supply disruptions, in the medium term, oil will go down and will finish the year closer to 100 than 120.
Darius, Christine here again. In terms of strategy, I understand you're playing the China market. You're very bullish on the China market. Is it because valuations are looking cheap, or do you think you expect, this is basically the bottom?
I believe that valuations are not really cheap, because at about 22 in terms of future earnings, they are almost the highest in the world. However, they are much cheaper than they were 6 months ago, half that level. And given the fact that the market is still determined to a large degree by the government, and the government, I'm sure, will want an upward trend before the Olympics, I'm quite convinced that we have seen the bottom and that we will move higher over the course of the year. Our target for the end of 2008 is 4,500 for Shanghai Composite.
Of course, Sean, the Chinese impact on your area of specialty commodities has been all important. But, you know, right now, where are you placing your biggest investment? You say, you know, oil might be vulnerable because of it's taken some of the play of gold and the risk appetite.
Yeah, I think we've been looking at trying to differentiate between the areas. I mean, if you look in the energy market, for instance, natural gas has been very strong. Inventories have fallen dramatically. They're a 4-year seasonal low. There's still a big speculative short in the market. It's had a big run, but possibly has another dollar from here at around about 11 in the contract to 12. You look at the agricultural, for instance, you can see a clear three-way split. Wheat is now in something of a short-term bear market because it's been overplanted and we've had good harvest news, or potential harvest news around the world. Soy's sideways, corn's been underplanted and so is still in an uptrend. So I think there are still things to play. I think the overall direction of this market, however, is a bit more suspect still because it's been an anti-paper money thing, anti-financial asset thing. As this rally continues, then commodities overall have slightly less weight attached to them.
Hey Darius, Christine, following on what Sean just said about commodities, in particular oil, as oil continues to head upwards, I mean, at what point would it start to really crimp and have a drastic impact on corporate earnings?
It depends a lot on the crack spread, because if we have widening of the spread at a time when oil is rising, then it would really bite the consumer, and earnings of the consumer sector would really deteriorate. On the other hand, the energy sector would benefit from that. But in the longer run, it's not a zero-sum game, and gains in crude so far have already bitten into consumer spending in the US. It's difficult to put a number, but at oil at around 150 would definitely deepen the US recession quite dramatically and would also prolong the earnings recession there.
$150. Whoa. Okay. All right. Let's hope, you know what, it'll take a long time for us to get to that level. Darius, thank you very much for talking to us. Darius Kowalczyk, Chief Investment Strategist, CFC Seymour. And Sean, thank you very much as well. Sean